In this session, I'm going to walk through a valuation of Apple that I did with my students last week. In the process, I hope to underscore some of the major concepts from prior sessions. As you can see from the chart, Apple and many of the other FANG stocks have been strong performers recently. Apple stock is up 46% year to date, compared with the S&P 500, which is up just over 16%. Given the recent run, we thought it would be interesting to value the company. The recent performance has been driven, in part, by a new upgrade cycle. Apple, which generates 2/3 of its revenue from iPhones, just introduced the iPhone 8, 8 Plus, and 10. As you probably know, the typical upgrade cycle occurs every 2 years. That said, the class and I thought that the company may be entering a super cycle driven by new product innovation. More importantly, we didn't think the supercycle was reflected in the consensus estimates, so we set out to verify that assumption. We started by digging into the company's most recent 10-K and found that Apple disclosed $37 billion in payments related to supplier agreements. This is a 32% increase year over year and consistent with the last supercycle, which occurred in late 2014 and early 15 as part of the iPhone 6 upgrade cycle, when the company began introducing a larger form factor. Calling out this outsized purchased obligation signaled, at least to us, that the company expects strong demand for their new product offerings. Importantly, we didn't find this analysis in a review of recent street reports. Something else notable is that the iPhone 6 supercycle was supported by unit growth, but ASPs didn't change. With the iPhone 10 selling at more than $1,000, we expect sales to also be supported by higher ASPs. This view was supported by a Piper Jaffray survey of over 300 iPhone owners. The survey pointed to significantly higher upgrade intentions compared to a similar survey last year. In fact, nearly half of those surveyed indicated that they plan to upgrade, but haven't yet purchased the iPhone 8, suggesting that they may buy the iPhone 10 at the higher price point. A review of the company's 10-K also revealed that Apple expects to double services revenue by 2021. At $30 billion, services currently represents only 13% of Apple's total revenue. While a small piece of Apple's business, this is nearly as much revenue as generated by Facebook and more than Alibaba last year. Using management's targets, we estimate a 19% compound annual growth rate, or CAGR, for services over the next 5 years. The services segment has high margins. While not disclosed, the Street estimates services margins to be between 55 and 60%, compared to the company's overall margin of 38%. After our review, we settled in on two major thesis points. The first is that the company's sales will benefit from higher ASPs from the iPhone 10 and a continued shift to SKUs with larger screens and storage configurations. The second was that the product mix shift and rapid growth in services would lead to margin expansion over the next few years. As I discussed in a prior video, we need to link the tenets of our thesis to our model. In class, we worked through the process for Apple. For example, our view on higher units and ASPs from the supercycle translated into 20% revenue growth in 2018 and a 2018 to 26 CAGR of 3.7%. With mix shift to SKUs with higher price points and a larger contribution from the high-margin services business, operating margins are expected to expand from 27% today to 30% by 2019. With similar levels of capital intensity, free cash flow is then expected to grow at a CAGR of 7% over the next 10 years.